Hello, my name is Paige Smith, and today I'll be doing a financial analysis on 3 different companies to answer 3 different questions. The 3 companies are JCPenney's, Dillard's, and Sanderson Farms. And the 3 questions are: which company would I give a short-term loan to? Which company would I give a long-term loan to? And if I had the opportunity to acquire equity side of a company, which would I acquire? To begin, we will look at the first question. Which company would you make a short-term loan to? To determine this, we are going to look at quick ratio, current ratio, and cash ratio. The quick ratio measures the company's ability to meet its short-term obligations with its most liquid assets. The higher the ratio, the more liquid. Comparing the three, Sanderson Farms has the highest quick ratio at 1.92. This means that they have $1.92 of liquid assets available to cover each dollar of current liabilities. The current ratio is a measure of short-term liquidity, meaning that the company is able to pay back its short-term liabilities with its short-term assets. Sanderson Farms is more able to pay back its short-term liabilities than Dillard's and JCPenney's. The cash ratio measures the company's current assets over its current liabilities. Just as the other two liquidity ratios, you want this to be as high as possible, because the higher the ratio, the more liquid the company is. And again, Sanderson Farms beats JCPenney's and Dillard's. So which company would I give a short-term loan to? It would have to be Sanderson Farms. Now, which company would I give a long-term loan to? To determine this, we are going to look at total debt ratio and equity multiplier. The total debt ratio measures the company's leverage. The more leveraged a company, the greater the risk. So with that being said, we want this to be as low as possible. As you can see, Sanderson Farms is fairly lower than the other two companies. The equity multiplier measures the company's total assets over its total equity. Dillard's isn't as bad as JCPenney's, but Sanderson Farms looks better than the two. So this is why I would choose Sanderson Farms to give the long-term loan to. And lastly, if I had the opportunity to acquire equity side of a company, which would I acquire? To determine this, we are going to look at return on equity, return on assets, price to earnings ratio, and the market to book ratio. Return on equity tells us how much profit a company generates with the money that shareholders have invested in their company. As you can see, JCPenney's is in the negatives, so they aren't producing a return for their shareholders. Sanderson Farms and Dillard's are in the positives, but Sanderson Farms has a higher return. Return on assets shows how efficiently a company is using its assets to generate income. JCPenney's is still in the negatives, not generating income, but Sanderson Farms is looking good on their return. Price to earnings ratio shows us how much investors are willing to pay per dollar for earnings. Dillard's is actually higher than Sanderson Farms, but JCPenney's didn't have a price to earnings. Market to book ratio is the market value per share over the book value per share. Dillard's has the highest market book ratio out of the three. But since Sanderson Farms prevails in ROE and ROA, they would be my choice if I had the opportunity to acquire equity in their company. This has been my financial analysis on JCPenney's, Dillard's, and Sanderson Farms. Thank you.